the question that everybody is asking me, they called me from Asia to come and talk on the media last night, national media here in the US this morning, is are we setting ourselves up with the big tech run for another 2000 style internet crash? Hey guys, welcome to the first edition of Rob Luna's Wealth Talk. Today's Friday, and today is a pretty interesting topic. I just got back from talking on a major national media network about what's been going on this week in the market. It's been really quiet for the past several months. All we've seen is stocks going up and up, and this week we're starting to experience some significant volatility. We saw the major indexes, the NASDAQ, the Dow, in the S&P absolutely plunge yesterday. Market's getting ready to close right now. We opened up down really low, but it looks like we might be kind of minimizing our losses going into the close. And so the question that everybody is asking me, they called me from Asia to come and talk on the media last night, national media here in the US this morning, is are we setting ourselves up with the big tech run for another 2000 style internet crash? Is that what we're about to see? So today what we're going to do is talk about some of the similarities of what I'm seeing in today's market compared to when I was trading actively in 2000. I'm also going to talk about some of the key differences, and most importantly, in terms of an action plan for you, what can you do to protect yourself in today's market and coming into the fall, which is historically a very volatile season. And when you add on the election and the polarization of what we're seeing going on with the election this year, some things that you can do. So first, let's take a look at some of the similarities that we're seeing in today's market compared to what we saw in 2000. Well, like I said, we've seen things just going straight up. When you look at what they're calling the stay-at-home trade, the big companies that are leading that, companies like CrowdStrike, who protects your computer when you're working from home. Companies like Zoom, what I'm recording on right now, that's allowed people to take things like conferences, inter-office communication, and digitize that onto a platform that's easy to use. Companies like DocuSign that are now allowing all the transactions that needed to be done before in your office to be digitized. All these companies have really been the big winners in today's market, and people have been flooding into those types of names. That was similar to what we saw in 2000, where anything that had a .com in its name, whether that was a new company coming to market, or I remember this old apparel company that made underwear, all of a sudden went online, and I think it was Hanes.com, all of a sudden that stock started to rally. So what you're seeing is kind of this new innovation today, the new stay-at-home names that are really at the forefront of changing our economy, similar to 2000, that are leading the market here. So that's one of the similarities. Also, what I would say is, when I started the market in the late 90s, before the crash in 2000, it was really at the beginning of online trading. E-Trade was probably the first company to really do that on large scale. So that was the first time that you really saw the average investor, who used to have to call their broker, place an order over a ticket, it would take a day or two, pay hundreds of dollars to buy a few shares in a company, was now able to log into their computer and just place that trade for $9 or $10. So the average investor in the late 90s, was right before the crash, was getting into the market in a really big way. Well, today we're hearing about the Robinhood investor, which is really, again, kind of democratized investing, has made it very affordable through fractional share buying, no trade commissions for the millennial investor, which is now the largest generation in US history to enter the stock market. So what we're seeing, just like we did back in the late 90s, is today's investor, what we're seeing, especially during COVID, as everyone's locked at home, is making trades in the market at the first time. Now, what they say about that is the average investor versus institutional people like myself and our money, who are a little bit more calculated with the investment decisions we make, pension funds, endowments. Well, that retail new investor is what they call the dumb money. And so what people get worried about is when you see a lot more of the dumb money coming into the market, are things getting frothy? Is it time to take profits? Are we setting ourselves up again for a 30, 40, 50% internet style crash like we saw in 2000? And remember, markets go up and down all the time. That's nothing new. what was challenging about the 2000 market is when that crashed, it took well over a decade just to get back to even. So that's what you want to avoid as an investor. Ups and downs, 5, 10, 15% here and there is normal, but you don't want to put $1,000 into the market today and wait 15 years just to get that $1,000 back. So those are some of the similarities I think that we're seeing that we talked about with today's market versus 2000. But importantly, there's some huge differences of what's going on. So I mentioned those companies, the pets.com, Hanes.com, all of these companies, a lot of which are not around today, Lycos, were really fictitious companies. They were idea companies, but they didn't have real revenues. They didn't have a great business model. Remember back then, that's when AOL started, the dial-up internet. So really being able to facilitate commerce, do a webcast like we're doing right now is absolutely impossible. The internet really wasn't prepared for it at that time. And ultimately, the vast majority of those companies wound up failing, I would say well over 90%. But let's remember, Google came out during that time. Amazon came out during that time. Amazon today, obviously, by market cap, is one of the largest and most profitable companies out there. So while there was a lot of fictitious companies that went the way of the dinosaur, there was also some real big winners to be had at that time. And so when you look at the internet today, obviously, 5G is just around the corner. We obviously all have access to cheap, if not free, broadband. We've seen the Amazonation of and the digitization of our economy now for several years. I think what COVID's done is just really extrapolated that, pushed maybe that demand forward. And from a standpoint of the average person, just like we're doing today and we're doing with the clients at our firm, people are much more comfortable now and actually sometimes prefer doing things online, whether that's conferences, purchases. So I think that's really sped up that trajectory today. These are real companies. When you look at some of the internet companies of today, let's look at Facebook. Facebook's a major leader. These guys are making real money. They've got $58 billion, billion with a B, in just cash on their balance sheet. So forget anything else. There's just cash that's sitting there of 58 billion, which is larger than a lot of companies just on their cash size. Also, what's important, what we'll talk about in future videos, is free cash flow. Free cash flow is what you can spend. So that means to you, if let's say your overall household expenses are $5,000 a month, if you make $7,000 a month, when that comes into your house, after you pay off your $5,000, you've got $2,000 left. That's your free cash flow that you can spend. So myself, as an advisor, as an analyst, what I spend most of my time doing on analyzing anything, whether it's a real estate deal, whether it's a little different, but whether it's a small company, private company, large company, is what is that free cash number? That free cash flow is what you're able to spend. Facebook today, $21 billion in free cash flow that they have in excess. When you look at a company like Apple, 200 billion in cash sitting on their balance sheet with 60 billion in free cash flow. Amazon, 70 billion with $21 billion in free cash flow. The list goes on and on. So not only are these companies profitable, but they're some of the most profitable companies out there today. And so what's happened is, in this big decline that we've seen, what's been really interesting is traditionally in the stock market, when you see a pullback, the names that tend to do well are those old stodgy companies, your Verizons, because everyone needs telephone service, your Procter and Gamble's, your value stocks that are paying a dividend. Well, those stocks actually didn't do too well, and most of them are still down year to date. But when you look at the internet stocks, these companies like Facebook, Amazon, Google, Netflix, DocuSign, Zoom, CrowdStrike, Palo Alto Networks, these companies have actually thrived because when you think about technology, these companies are asset light, so they can pivot and move on a dime. They're set up to be able to adjust much quicker than, let's say, Ford, who has a factory, who has to, big heavy assets in place, workforce. They can't change to adjust with an economy as quick as a technology company can. So what we've seen through technology companies, not only have they held their own, but they've actually exceeded on their top line guidance. They've exceeded on the bottom line and the money that they're earning. And these are the companies that have actually really done very well during this environment. So that's been something very, very different. So when I look at today's market, people that are saying, oh, this is just another, dot-com bubble, very, very different. These are not only profitable companies, but when you look at the S&P 500, those 500 companies out there, these are the most profitable companies. And really, as we all know, and we've known for a while, this economy is changing. So the way that you need to analyze these companies, look at them going forward, is very, very different. And I'll just kind of give you another thing to think about. One very powerful thing in investing is narrative. When you look at two Nobel Prize laureates, Richard Thaler, Robert Shiller, they're talking today about, yes, understanding the balance sheets and all those traditional financial metrics that we learn in college. But what's equally, if not more important, is understanding the narrative of what's going on. And so when we put that into perspective of what's going on today, something that's been really powerful in my career is if you can catch a narrative early, and when a stock becomes a verb, that's the time you want to take a look at it. So for example, if you're looking on the internet, do you internet search things or do you Google things? Well, most of us Google things. Today, when we talk about having an online meeting, people say, are you going to jump on that Zoom? When someone sends you a document to sign, are you going to DocuSign this? So DocuSign, Zoom, full disclosure, two stocks we don't own, but when we're seeing these companies get beat up in a couple of days like we've seen today and tomorrow, those are the companies as an investor you might want to start doing some research on. You might want to start thinking about owning, because I do not believe that those companies are going to be going anywhere anytime soon. I think DocuSign is here to stay. I think Zoom is here to stay. And if you can buy those companies at a discount when everyone is panicking and throwing those out with the bathwater, that's the time that you want to jump in. But so what should you do in general? One of the things that I've been talking about on the national media now, really actually since last year, is having a barbell approach to your portfolio. And what I mean by that is all these technology names are great. I invest in those personally. I think they're the way of the future. Those are going to be your biggest gains if you look out over the next 20 and 25 years. But trees don't grow to the skies. Those things are going to be very volatile. You'll see 20, 30, 40% pullbacks, sometimes in a matter of a week, even a couple days, like we've seen 15, 20% in some names just over the last 48 hours. But those are the times that you want to, kind of buy those names. So you want to have those stocks as part of your portfolio, but also on the other side of that barbell, you want to have something different. So for example, year to date, we haven't seen some of the banks do very well, some of the financial companies. When you look at a company like Goldman Sachs, one of the largest wealth management companies out there, some of you might have online savings accounts with Marcus. Well, right now, Goldman Sachs, because it's not that sexy internet company, is trading at a very, very big discount. There's something called book value, which we'll get into in further videos, but basically just says book value is if they look at you, for example, what is the equity you have in your house, the cash that you have, the balance sheet, what is the furniture worth there? If we add that all up and let's say it's 100, well, if we liquidate you, we should at least be able to get $100 because that's your book value. Well, if we could do that for $50, well, that's a discount because we just buy you out, sell everything at a yard sale, and we make $50 on it. So Goldman Sachs right now, in full disclosure, I own the stock. Some of our companies, our clients own the stock. Goldman Sachs is trading at a discount to its book value. Very rare for a high quality company that you see that. So that's something that you might want to look at today. Energy is a little bit of a controversial topic, but when you look at a company like Chevron, well, Chevron today, again, is trading at a discount to where it's been over the last 5 years. This is a company that has about a 5.5% dividend. A dividend is something that even if the stock does not increase in price, that's 5% that's getting paid out to you in cash. When you look at today's environment, look what your savings account is getting. 5% is a very, very good yield. So what you want to do in today's market to protect yourself in days like today, in days like yesterday, is have a balance. Have some of those, older dividend paying, safer companies that are trading at a discount on one side of your portfolio, which have actually held up really good during the last 2 days. But then have your big technology names that you like that will help you out long term on the other side. And that's really the best way to protect yourself in this environment. So in wrapping up, what we're going to say is no, I don't think this is another 2000 style crash. There's just too many differences that are out there. I think, this pullback could last another 10, 15%. Would not surprise me how fast we're coming, but this is an opportunity to get out your shopping list, take a look at some of those companies. Like I said, I'm looking at DocuSign, I'm looking at Zoom, companies that I don't own. If those get beat up a little bit more, I'm going to start dipping my toe into those. Now, if you've been in all those names already, this is probably a time to maybe take some profits and look at some of those other names that we talked about on the barbell. But I think we're in good shape. I think you just need to balance your portfolio. There's going to be a lot of scary headlines probably coming out over the next week, but we're here to help guide you for those. We'll be doing this again next Friday after we have another week. Labor Day shortened week. We know the money market's going to be closed on Monday. We'll be back on it on Tuesday. We'll be talking to you Friday. So until next week, wishing you an abundance of health and wealth, and we look forward to seeing you on the next one. If you haven't subscribed, please subscribe below to my YouTube channel. We plan on talking about a lot of good stuff on a weekly basis. Thanks a lot.